2023 is finally here. We have compiled a list of the 5 most promising stocks to invest in this year. The COVID era is gradually easing up, yet 2022 was a year marked by growing prices, skyrocketing interest rates, and recession worries. The S&P 500 fell over 20% year-to-date, growth in technology sectors were battered, and the energy sector emerged as the clear winner as the unexpected commencement of the Russian-Ukraine conflict disrupted global energy markets. However, the prevailing situation has primed stocks for resurgence heading into 2023. But in any case, here are the top 5 stocks to purchase in 2023. Number 1. Microsoft. Despite a 28.5% drop so far in 2022, the value of this consistent growth stock has increased by nearly 180% in the previous 5 years. The company's expansion is mostly due to the operation of business units with significant market shares in the various rapidly rising sectors, such as cloud computing and IT services. Microsoft has what it takes to continue increasing its companies in 2023 and beyond thanks to mega popular brands such as Windows, Office 365, Xbox, Azure, and LinkedIn. According to the Grand View research, the $369 billion cloud computing industry is projected to have a compounded annual growth rate of 15.7% until at least 2030. Meanwhile, Microsoft's Azure cloud platform has a staggering 21% market share within the cloud computing industry, only behind Amazon Web Services at a 34% share. Microsoft's Intelligent Cloud division has been the company's fastest growing area in recent years. Revenue jumped 20% year-on-year to $20.3 billion in the first quarter of the fiscal year of 2023, while operating income increased 17% to $8.9 billion. Microsoft is already profiting greatly from the current market expansion, and it intends to develop further in the sector in 2023 by creating additional data centers in emerging areas such as Asia and other countries. Furthermore, Microsoft's 2021 purchase of digital advertising star Xandr might pay off big next year. Owing to its new agreement with Netflix, Microsoft has agreed to be the exclusive provider of advertisements on Netflix's ad-supported streaming tier, which debuted in November. The following year will give Microsoft more opportunity to reap the benefits of the alliance as it engages in the digital advertising industry, which is anticipated to reach $786.2 billion by 2026. Microsoft is only getting started in the digital advertising business dominated by Alphabet and Meta platforms. On the other hand, the corporation has had a history of entering new industries and sectors and eventually establishing domination. With a free cash flow of $63.33 billion as of September 30, Microsoft is well positioned to invest in and develop in several companies in 2023. Number 2. Advanced Micro Devices. AMD is an American semiconductor company that develops computer technologies for businesses and consumer markets. Consumer expenditure in the PC business fell drastically in 2022. According to IDC, global PC sales will fall 15% in the third quarter of 2022 as increasing living costs reduce discretionary expenditure. As a significant participant in the sector, AMD stock has been down around 54.6% year-to-date. Despite a sell-off this year, it has historically remained as one of the top growth companies throughout the last decade, with shares up to 500% in the previous 5 years. While AMD is best known for its graphics processing units and gaming PC components, the firm has also made profitable operations in console gaming and data centers. In fact, AMD's cloud computing data centers accounted for the majority of sales in Q3 2022, earning at least $1.6 billion and increasing 45% year-on-year. As the cloud computing sector continues to thrive, data centers, including AMD, are enjoying the benefits. Furthermore, gaming revenue increased 13.7% in the quarter, reaching $1.63 billion. Despite reductions in the GPU industry over the previous year, AMD continues to enjoy growth in the category due to its critical position in gaming consoles. AMD is the only supplier of graphics and processing power for 2 of the world's best-selling gaming consoles, Microsoft's Xbox Series X and S and Sony's PlayStation 5. Given both Sony and Microsoft are likely to produce beefier versions of their consoles as soon as 2023, AMD is well positioned to maintain its console sales growth. In 2022, technology businesses were especially affected, with AMD shares left bruised and broken. However, the company's diversification and presence in the higher performing sectors have allowed it to continue to thrive. In 2023, AMD stock will likely continue to receive considerable increases from data centers and console sales, and if consumer demand in the PC industry recovers, AMD stock will only likely grow more appealing. Number 3. Amazon stock. Winners will continue to win. That's one of Warren Buffett's most famous statements, and Amazon has proven it over and over again. Amazon has come under fire this year after seeing rapid pandemic expansion. It's a near-perfect storm of issues, including difficult year-over-year comparisons, a tight economy, and the elimination of a big infrastructure that is no longer required. Amazon reported financial losses in both quarters of 2022 and issued a bleak forecast in the fourth quarter of 2022. All of this has lowered investor confidence, and Amazon stock is down by almost 50% as the year comes to a close. However, the future is looking promising, and things might improve as early as 2023. Amazon has begun the sell-off of retaining assets that it doesn't need while laying off the unnecessary workforce, closing distribution locations, and cutting other expenditures. The economy's outlook for the next year is unknown at this time. However, it seems that the worst of the increasing interest rates is behind us. While inflation is now leveling down, that implies that Amazon is in a good position to generate stronger earnings in 2023, and its stock is primed to skyrocket. It is by far the most well-known brand in e-commerce, and it is constantly enhancing its delivery services and boosting its Prime user base. Additionally, there's the Amazon cloud computing cash cow Amazon Web Services, which continues to be extremely lucrative. It boasts some of the highest profit margins amongst the plethora of services Amazon offers. However, this segment's sales growth has lately slowed marginally, but as the economy recovers, it should quickly return to normal standards. Finally, there's everything else that Amazon is doing, including creating a new healthcare product with its purchase of One Medical. Amazon's future is bright, and its share price is currently at a very attractive level. Number 4. Coca-Cola. Coca-Cola has historically proven itself to be reliable and resilient. Having paid dividends for more than 50 years consecutively, Coca-Cola is a renowned dividend king and is the fourth largest holding of Warren Buffett's Berkshire Hathaway portfolio. This year, Coca-Cola stock has lived up to its reputation as a great defensive holding. This year, its shares recovered 7.5%, surpassing the S&P's 500 index's 19% loss. Coca-Cola is still a strong company to consider throughout 2023. Coke now has almost everything an investor might desire as a core holding. Because of its brand strength, the firm has been able to increase prices to keep up with inflation without reducing sales for volume. For example, revenue grew 10% year-on-year in the third quarter, driven by a 12% rise in selling prices and a 4% increase in unit case volume. Furthermore, the firm is producing significant free cash flow, fueling reinvestment across its beverage portfolio and dividend payments to shareholders. Over the previous 4 quarters, Coke earned $10 billion in free cash flow on $42 billion in sales. Coke paid out 57% of their profits in dividends, resulting in an above-average return of 2.77%. In this turbulent market, the company should continue to outperform the larger market due to the pricing power and a strong dividend yield. Long-term, Coca-Cola's prospects to acquire market share in the developing beverage sector should provide stockholders with adequate returns. Last on number 5, RH. The final stock on our list is RH, a luxury home furniture company. Previously known as Restoration Hardware, has repeatedly proven its value and is considered to be a dark horse pick. The company successfully shifted to a membership model, charging its loyal customers $175 per year for a 20% to 25% discount on their merchandise. This has provided the company with a new revenue stream as well as a base of loyal customers, which will aid in the launch of new products such as chartered jets and yachts, hotels and restaurants, and a streaming service devoted to architecture and design, all of which are part of the company's long-term strategy of expanding the brand beyond furniture sales. That strategy proves a significant growth potential for the company, but the core business has its own advantages. For example, RH consistently earns operating margins of 20% or more, which is far higher than the average home furnishings firm, which demonstrates their pricing power and the strength of its premium brand. While CEO Gary Friedman has said that the macroeconomic situation may worsen before it improves, RH is set for long-term development and has proved its brand capacity to produce exceptional profitability. If its new ventures do go off though, the stock is primed to soar from here. Buying stocks during a slump or recession, despite going against most investors' inclinations, has historically yielded the biggest and most consistent returns. Yet, should you invest in growth or dividend stocks in 2023? Find out in this video. Thank you for watching, please subscribe, and have a happy new year!